Hello and welcome to Damien's Midweek Markets, the show where I talk about what's happening in investment markets and what's going to happen in the coming weeks. Now, last week I talked about the German DAX and the importance it had for the stock market globally, particularly in the US, where we've got an equity rally. Now, I talked about some key levels to look at, and 80/20 investor members will have had some more in-depth analysis on that. And so I thought it'd be handy just to recap where we are with the DAX. And the DAX has actually got up to 12,200, which is smashed straight through that key level, which was showing signs of strength, which really does give some momentum to the bullish case for stocks at the moment. Now, that's not to say that we aren't going to pull back. The rally's been so strong since the beginning of the year that it's always likely that we're going to have some negative pullback. But momentum is definitely rising, and the buy the dip mentality has been profitable of late. And so we're seeing the DAX actually start to outperform the S&P 500 at times, which it hasn't done for an incredibly long period of time. And in fact, the DAX is now at a 6-month high. So if we wonder why is that, what is driving it? Because if you look at it from one angle, the economic forecasts from Germany have actually been cut in the last week. And we've had news that car sales in China have dropped. And of course, Germany exports a lot of cars to China, so it has a big impact. And the other thing we had is angst over possible trade wars between America and Europe, particularly relating to cars and car sales. So why is it picking up? Why is the DAX doing so well at the moment? And a lot of it is to actually do with the earnings expectations of companies. Now, we've got an earnings season at the moment, so it'll be interesting to see how that plays out and going into the later part of the year. But expectations from analysts are for European earnings to pick up and probably exceed those in America. So we've seen some bullish momentum in European stocks, particularly in Germany, which has obviously added some fuel to what's going on in America. Now, we've even seen the Nasdaq 100, which is very tech focused, hit a new all-time high. Now, Germany isn't doing a new all-time high, it's a 6-month high, but it is all moving in the right direction. Now, I mentioned China just a minute ago, and China is key. China is important to what's going on globally at the moment. We're entering what it feels like an economic downturn, but China has been pumping stimulus and monetary stimulus and fiscal stimulus into their economy to try and stop a hard landing for their economy. And a lot of that's been a result of the ongoing trade angst and trade war with America. The trade talks are still ongoing. There's supposed to be they've said that we might have a signing ceremony at the end of May. They said that at March and in April as well, but there's problems for the Chinese economy. But what we had this week, we had the official figures come out for the most recent quarter, and they showed, they beat expectations. Now, that's great, but we have to realise with Chinese economic numbers, they're slightly, how could I put it, almost made up. A lot of analysts don't put so much weight into them because they beat expectations and they don't necessarily go into a great depth as other economic numbers that are officially released around the world. So that explains why equity markets didn't necessarily rally immediately when the numbers were released in any significant way. Where we did see a pickup in stock market prices in China in particular is where we had announcements of increased liquidity over there from the authorities. Now, that saw the Chinese stock market jump 2.8% in one day, which is a big jump. And given the rally we've had this year, which is probably somewhere near about 30% year to date, it's been an amazing rally for Chinese equities and the stock market globally. But we didn't see that pattern replicated through the whole of Asia. It was very mixed. Sort of some equity markets were up or down. That's because they are still obviously concerned about economic weakness globally. But we also saw things like the Aussie dollar pick up, it rallied. And that's because their economy is very reliant on commodities, and obviously they export a lot to China. So if the Chinese economy picks up, it's good news for the Aussie economy and therefore the Aussie dollar. So it's one of those sort of correlations to keep an eye on. So in summary, the Chinese economy matters to the whole world, and the positive news, depends how much you can believe it, has given a very risk-on feel to investment markets at the moment. But what is interesting is it does give China a bit of wiggle room when it comes to the trade negotiation that's going on, because if their economy is actually picking up and they are starting to recover, the stimulus is working, then it makes them a bit more, it actually changes the dynamic slightly because they don't have to be so accommodative to what America wants. But the other question it raises is whether the dovish turn or the dovish change in stance of global central banks has actually averted a crisis of some kind, particularly a recession, which we only learn going forward. Some economic numbers still disappoint, some are actually improving. We had some good numbers in the UK in retail sales, but we still had some weak numbers out of Europe. So we're still going to have to wait and see. In terms of the S&P 500, we're still where we were last week largely. We pulled back again, broke below 2,900 but closed above it. Closing prices are always more important than the intraday ones because it's almost like where the final money is put. So it always focus on closing prices typically, but it just shows that 2,900 level is still a key support level. Below that you're going down to like 2,880 and 2,850, and as I said last week, if we go below 2,790 then the alarm bells will be ringing. So we're still in that rising triangle that's happening at the moment. So the market, we still got that feeling that there's going to be a day of reckoning sometime soon. Now, I also mentioned last week that one of the key things we're going to have is earnings seasons getting underway. And the earnings season in the US has been coming along quite nicely. We're only a few days into it, but there's not been any huge surprises or shocks, should I say. So there was a lot of expectation there were going to be some awful earnings that were going to disappoint analysts' expectations. Yes, expectations are lower than they may have been previously, but we haven't had any shocks as yet. But as I said, we're early days in the earnings season. Going forward, it will be interesting to see what happens when we get towards the end of the month, particularly with companies like Apple, who are releasing their earnings figures at the end of April. Now, don't forget that the previous sell-off was centered around a lot of what's going on with Apple as well, because we had Apple downgrade their forecast for the previous quarter, which caused a bit of a wobble in stock market. So Apple is so big, they have a huge impact on where the stock market goes. As the saying goes, as goes Apple, so goes the market. So it's a case of as you were, but keeping an eye on what's going on in China, because the Chinese stock market is still doing rather well, and the economy, if it starts to pick up, that's good news for the rest of the world, particularly Germany and anybody who exports to them. Now, there won't be a Midweek Markets podcast next week, and that's simply because I'm recording this on a Thursday, and there's going to be a bank holiday, 4-day bank holiday in between. So by the time we have next week, not a lot will have changed in the market. So I'm going to leave it a week and we'll come back at the end of April. So 2 weeks time, by which point we've had more of earnings season, and hopefully the markets have decided which way they're going to go, whether they're going to break higher or break lower. But keep an eye on that VIX level, the VIX, which is the market's fear gauge, because we're still stubbornly low, which is a sign of either complacency or a lack of fear in stock markets. So that's it for this week. Until next time.